Hi. Until now, we have discussed about the understanding the annual reports from the part one, where we understand about the company's performance, looking at the risk, looking at the news outside the company so that we can relate them to the financial of the company and build an understanding about expectation about how the company's operating statements would look like if given the understanding of the external pressures or external factors. Now we have also looked at the overall financial data plus also the management discussion and analysis, where we get to know a little bit more about the company to to see what the company is doing. Now we're gonna verify our understanding and look at the Excel analysis of their balance sheet to see if there's any other thing that is not explained in the management discussion and analysis, but we need to know in order to understand the profitability better. So the first thing that we normally has to do is to download the P&L into the Excel, which we saw in our earlier videos how to do that. And the next step would be to carry out a vertical analysis of the company, vertical analysis of the financial statements. So what to calculate the vertical analysis, it requires us to bring it to the common size, which means we're going to divide every line of the P&L by the total sales, because that's really the vertical analysis, right? And then we're going to be doing that for all the years. We're going to freeze the first B3, T3 and D3, so that we don't, when we copy the formula, it doesn't go anywhere. And then what you're doing is you are calculating it until the end to see what is this vertical analysis is basically telling us the ratio of cost of sales, cost of gross margin and everything else in relation with the total sales. Now we will be able to explain it in a better sense that now you can see the cost of sales has increased from 61% to 62% or 61.8%, which means pretty much that the margin overall is remain the same. But we have already seen in our management discussion and analysis that the possible reasons for this is because of the fact that it's this part is because of the segmentation is different, because in the segmentation we have already seen that the gross profit for products is actually dropping, which we can see here. Here you can see the gross margin for products is dropping, and for services is increasing. The company may also provide the data about the product segment analysis, the product segment that they have done earlier. Here the product segment has been done in iPhone, Mac, iPad, wearable and services. The company can surely provide a data for each product line so that you can able to know which product line is more profitable. However, to protect the company's competitive information about the confidential information about the cost of iPhone, cost of iMac, cost of iPad, they are not providing that much of detailed information. That information you can find out only by looking at the records of the company, which is not really accessible at this point of time. But if you are doing the financial analysis for the company or for doing the valuation or doing the due diligence, you will be able to get that data easily. So this is important for you to understand what to look for and how to look for. Now the next step in the analysis would be to, so whenever we are looking at the analysis from the Excel here, we not only look at the net sale and cost of sale in totality, but also by the segment. So it can be more on the product wise, can be by region wise, can be by other methods, whatever the company management feels better to represent the data. Then you have research and development expenses, which is 5.4, 6.2, 6.8%. This is increasing in compared to the ratio. You can see that in absolute terms is already increasing, right? But it's increasing in as a percentage to sales as well. And there is definitely a growth over a year, which we can see by conducting the horizontal analysis. So horizontal analysis basically is calculating the growth rate in 2020 and 2019 on the previous year. So the formula to do that is 20 divided by 19 minus 1 as a percentage, and then it will calculate at 5%. Then you just copy the formula to the next cell. It will calculate 19 over 18. So once you copy the formula, you will be able to see that the research and development expenses has grown by 14% and 15% respectively. However, with just only looking at the percentage increase does not help us. What helps us is the research and development, particularly related to the revenues. Since Apple is innovation driven company, and the lot of focus is on the research and development, you can see as much in equivalent amount of selling and distribution expenses is being spent on the research and development, which is quite large. That normally the companies are spending much less amount on the research and development. So you can compare that by having a competitor built into this segmentation. Now we are looking at standalone pictures at the moment, but however the next step that we have to do is really to find out who is the competitor. So based on your understanding of business profile of the company, that it's making the laptops, making the wearables, making the services, making the phones, the natural competitor would be probably Oppo, it can be Samsung, it can be Vivo, or it can be any other company which is out there in the market selling these things, right? So you really have to find out the profit and loss statement of that particular company, put it into the same segment. So you can say, okay, what is the total sales, what is the gross margin, what is the research and development. I am not doing that here because you can find that information and plug it in as a part of your exercise and then submit back to us, and then I will create the assignment in the lecture in the class, so that you can submit it and then I can have a look at it. You can do your analysis in the way that I am teaching you, so that we can see if you have learned something or not. Then you have selling expenses, other operating expenses, total operating expenses. Here you will see the total is there 11%, 13% and 14%. If you remember, there was no explanation given this is the total operating expenses, so which is total of the two items, which is the similar way that we have already been expenses. The selling distribution expenses has been increasing. There is usually much more details in the profit and loss statement, in the details in the schedules, so we can look at that later on. And then here is basically this net income has been dropping consistently because of even though the net provision for net tax is dropping compared to the sales, the other operating expenses are dropping, but the overall operating income is also dropping, which can be a concern for the investors, because the profitability of the company is on a continuous drop, which is not a healthy sign, but depends on the time, because research and development is normally for future years, not for the current year, right? So whatever you are spending on this year is gonna benefit you in the future year. So it depends on what type of research and development expenses we are doing and what are the chances of its success, how much it will help us in building the products in the future that may continue to drive the profitability of the company. Otherwise, the profitability, even if you want to improve the profitability, you can save on research and development expenses. However, if you try to reduce the research and development expenses of the company in order to maintain the profitability, it will cause the problems in the future when you don't have a product to sell and your competitors are going to outcompete you from the market. So in this way, the company is still healthy. Now the million dollar question is, what is the return on the equity? So here you can calculate the return on equity based on the EPS is there, earning per share. The value on the price of the company you can calculate. Equity is the share price of the market, the normal price in the market, and you divide that by the EPS, you will get return on equity. Simple. If you want to calculate return on assets, then you can calculate it here. So in the balance sheet you will see there's a balance sheet here. So the total of assets here, total assets are given here in this line. So you can calculate the return on assets. So you can easily calculate return on assets here. Let's see, where is the cursor? Wow. Return on assets. So return on assets is going to calculate by the profit, income, net income, divide by the total assets. Remember, these total assets are not all the assets which are used in the business and are producing. Usually it's only the market, the property, plant and equipments, and the other assets. But here the company has a huge cash and cash equivalent balance, and also the market securities, account receivables. So but let's first look at the return on equity. So the return on assets is about 15 to 16%, which is quite healthy if you are gonna invest, but it's not on the market price. If you invest today into the Apple, you are not going to get 17% return, because the market price of the Apple is the market value of market capitalization of Apple is much more than the market the value in their balance sheet. In the balance sheet, the value of the company is only $323 billion. Sorry, $258 billion. That's the net worth. However, the company is worth $1 trillion, so it's 5 times more, right? So when it's 5 times more, then your return is going to be 5 times less. So means divide by 5. Sorry, by 5. So here is only 3.5%. So that's the return the company is giving to its shareholder, new shareholder, whoever is going to invest into the company. So the one way to look at that is the price that you are paying into the share price in the market, and then EPS divide by that price. So you will get the actual return of this now. But normally the investment is not done based on the EPS that is already being generated. It is done based on the EPS which is supposed to be generated. So usually the companies also go into the extent of creating the future forecast. So that can be done by looking at the companies. Let's see, there was a segmentation here. Let me search it. In the coming tabs, usually you will get some data about the company, which is gonna give you the additional information. Dividend, number of tax, interest, deferred tax, reconciliation, income, debt, share repurchase, changes, unconditional segment. So here is the segment information about the company. Operating income, research and development expenses, operating income to the consolidated line items. No, it's not. Here is the long-lived assets. No, it's not. Okay, the company, there is no information about the segmentation here, but you can create that, and then what you can do is you can try that, use that information for making the forecast in the future. So and then you can really calculate how much the EPS would be at these ratios. So you have calculated the ratios, you can estimate based on this trend how much the company would be spending. Let's say you can say that the next year the company's total sale can be $300 billion. So you can actually build the profit and loss statement for the company based on this information. $300 billion. So the cost of sale, if let's say is continues to it remains at 61.8%, so you can use the latest one. The company will be able to earn around this much, 180 million, and then the company is gonna use the gross profit of 114%. If let's say companies spend another 6.5% or 7% on the market research, then the information is going to be this much. This is just my idea, but the actual, let's say the expenses are again the same percentage, and then you're gonna get the total expenses, and then you're gonna get the net operating expense. Here you get the net operating expense. Let's say the net operating the other is also 0.3%, 0.3%, and then you will get the net. Don't worry about that, it's gonna be fixed. Right, and then you are going to get the provision for taxes, which is 3.5% based on the recent information. Assuming the tax burden on the company is not going to increase, is gonna give you the additional savings. So it's 69B. Based on the basic share and the diluted share, your basic share is gonna remain. Let's say you're gonna keep it same, you're not changing it in this year as well. So the earning per share for the future is going to be, well, is not number, oh, it's the in the billions of dollars, right? It's the millions of dollars, right? So you have to multiply by the $1 million. Oh, sorry, it's in millions. Yes, is in millions, and basic is in the terms of shares. Oh, sorry, a share dollars are in dollar, shares in 1,000, shares are in 1,000, and it's 1 million, so we're gonna divide by only million, and then you're gonna calculate this, divide by this, multiply by 1,000. So here you get 3.96. So now you will be able to compare the price that you are paying on this. Let's say I say that in the next year 2021 the company is going to do this, so I would, based on my share price, based on $4 rather than 3.3. So that's how much I will calculate. Right, so let's get back into the course. The next thing you have to do is to understand the balance sheet.